Forex Nation, what's up guys? Welcome back to the channel. Welcome back to another video. As we continue the Blueprint Summit series, this is going to be day one, but part two. And in this particular video, we're going to break down market maker cycles and also give you a specific definition for each of the actual patterns that we trade. So let's jump right into it, and I hope you enjoy the video. All right, so now let's talk about what is it that we're trading, right? What's the method that we're trading? What does it look like? So we're talking about a market maker cycle. So there is a cycle that market makers use repeatedly over and over and over and over again, right? So the cycle looks like this if it's going down, and it looks like this if it's going up. Okay, so you could see that on the one that's going down, it starts with a big M, followed by a move down retracement, and then ends with a W. Right, so this would be basically a MAAW. For the cycle going up, it starts out with the W, and then you see a retracement, a move up, retracement, move up, and then it ends with an M, right? So it'd be W, V, V, and M, right? So there are certain things about this particular cycle that happens over and over and over again. So the first thing that you need to understand is that this cycle happens on any time frame. So it's fractal, and it literally happens on any time frame. So if you look on the daily, you'll see this cycle. If you look on the 4-hour chart, you'll see the cycle. If you look on the 1-hour chart, you'll see the cycle. If you look on the 5-minute chart, you'll see the cycle, right? So think about it like this. If you see this bearish cycle, this MAAW on a daily, how many days do you think that cycle would be to complete? All right, so how about if I told you that this cycle here on a daily chart could take up to 3 years? A great example of literally this is if you look at USD CAD on a weekly chart, you'll literally see this pattern. So imagine this M on a daily. If that M, just to create that M, let's say takes, I don't know, 6 months or something to make, how many of these same cycle patterns are inside of that M, to create it, basically? So think about the same thing on the first leg that comes down to create the first A here on that. That could be, I don't know, let's say a year or 6-7 months. How many of those miniature versions of those cycles are in it, are within it, is my point. So all this is fractal. So this particular cycle, this movement that happens over and over and over again, can literally be found on any time frame. It does not matter. This cycle does not follow any weekly sequence, meaning that this is not a Monday through Friday type of cycle. The closest thing that you can get to something like this on a weekly basis is a weekly trending cycle. So weekly trending cycle, you're very likely to see something very similar to this. So as we talked about, in a downtrend, it creates a MAAW, and in an uptrend, it creates WVVM. Okay? So this is what you're looking for on the charts. It just depends on what time frame you're looking at, whether or not it's going to be viable to you that day, or is it something on the bigger structure of the aspect where it could be, you're looking forward to the next couple of months. This M followed by the AA, the first A is like level 1, the second A it produces is like level 2, and then the W essentially is like level 3. So if you're looking for this pattern, let's say on a bigger time frame, let's say on a daily, right? And you notice that you see the big M, you've come down to the first level, the first A, you know that on a way bigger time frame, you still have way more movement to the downside to go. So if you're swing trading a pair and you're more of a long-term trader or thinker and you're looking at dailies, you know that the bigger picture is going to go to the downside if you're at the very first level. Contrary to that, if you're looking at a daily and you notice the pattern, the M, the A, and you notice the W starting to form, what does that tell you? It should tell you that the market should start to reverse on the bigger time frame. So you should start to shift your thinking from becoming an overall seller to a buyer. So let's go ahead and now talk about patterns and timing. Because at the end of the day, what we're trading is we're trading patterns. And those patterns happen at a very specific time. Okay? So that's what this strategy is all about. It's trading the patterns and the timing. So let's talk about the patterns. So there's going to be 4 types of patterns that we trade. Very simply, type 1s, 2s, 3s, and 4. Each pattern has a specific set of rules and characteristics. Each pattern has its own specific rules and characteristics. Now, I don't need you to be a master of all 4 patterns. What I need you guys to figure out is, out of these 4 patterns, which one speaks to you? Which one are you able to see the best? Which ones are you able to predict through your backtesting the best? When you go through some of these patterns and you start to backtest them, you are going to notice that you are way better at predicting type 1s than you are type 4s. Or you're way better at predicting type 3s than type 2s. So just know that up front, that we're not trying, the goal is not to try to trade all 4 patterns. These are just the best possible 4 patterns that you can trade. Now it's up to you to determine, based on how you see the markets on a daily basis, which pattern are you the best at. So the timing of each pattern happens at a major key and is a very important aspect of the actual trading of the pattern. So a good example of this would be, we're not looking for patterns during the Asian session, right? Like, we don't care if a pattern presents itself during the Asian session, because we're not interested in those patterns. We don't care if a pattern happens during, I don't know, 5 o'clock in the afternoon after the US session is over, right? The timing that we want is very specific, and I'm going to show you what the timing is. So very important that you don't need to be glued to the charts 24/7. So I don't know about you, but like, the reason I got into trading was because I wanted my time back. It actually wasn't because of money. I was already making good money at my job. So it was never about the money for me. It was about getting my time back, because at the time I had 2 very small kids and they wanted all of my attention, and I couldn't give them my attention because all of my time, majority of it, was spent at my job. So I just wanted to get my time back. So you don't need to be looking at charts 24/7. Whenever you first get into trading, How many of you did just that? Looked at charts literally 24/7. It felt like an addiction almost to looking at charts because you were scared that you were going to miss an opportunity if you weren't looking or paying attention to the chart. So now, with this, you have a standard that you don't have to worry about staring at the charts all day, all the time. You're only worried about a specific key point or key hours to pay attention to the market. So now you can start to reclaim your time back. So let's talk about the first one. So the type 1 pattern. What does that pattern look like? How do you describe it, right? It's basically a type 1 pattern is a sharp move that pushes outside of the Asian high or low. And we're going to get into the charts. I'm going to show you what I'm talking about and you'll be able to see it. But I want you to really grasp the description of it. It's a sharp move that pushes outside of the Asian high or low. This typical push or the move, the stop hunt move, is basically up to 50 pips when you measure it from the top or the bottom of the Asian box. So it typically goes up to 50 pips. It could be some days it'll be 25, other days it'll be 20, 30. We don't know because we don't know the numbers that they need to reach or hit via the market makers. We don't know the numbers. That's our only disadvantage, is that we don't know the numbers that they need to hit. But we do know their behavior, and we do know that they produce certain patterns. And so those are the biggest advantages that we have. So what are you looking for? You're basically looking for an M or a W formation to form after the push up of up to 50 pips. You're looking for an M or W formation after the stop hunt. The stop hunt being the move that happens when they go past the Asian box up to 50 pips. Now, take note of the fact that the best setups come when the apex of the M or W is 5 or more candles. What is the apex? The apex is basically the amount of candles between the first leg and the second leg of the M. That's what the apex is. The second leg of the M or W must be in the London box or the New York box. When we get into the charts, I'm going to show you the boxes. But an important aspect of this pattern, the ones that are producing, right, the trades, the good trades, the second leg of the M or W has to be in that box. This gives you a set of rules, a structure to follow. And that's the point. Another point is that we're not here to trade every M and every W. If you look at charts, you'll probably see a gazillion M's and W's everywhere. Am I wrong or am I right? If you look at any chart right now, you'll see M's and W's everywhere. We're not here to trade every M and W. We don't care about every M and W. We just care about the right ones that happen at a specific time that meet our rules that we're looking for. So what does that mean? It means that you may come to a day where you're ready to trade and ready to beat the market, but it doesn't produce the trade setup that meets your requirements. So there might not be a trade that day. And that's completely fine because you're not here to gamble your money. If you want to gamble your money, just go to the casino. At least you'll have fun losing your money. Losing your money while trading is not fun. Are you going to have losses? Absolutely, you're going to have losses. It's just part of the game. But you're not going to have ridiculous losses. All of your losses are going to be controlled, and most importantly, you're going to learn from your losses. You're going to learn from your losses. So that's a type 1 pattern. Type 2 pattern. It's basically a move that gets stuck at the top or bottom of the Asian range. So contrary to type 1 setups that go past the top or the bottom of the Asian box, type 2 patterns actually get stuck at the top or at the bottom of the Asian box. Price action doesn't move outside of the initial high or the initial low of the day that's set throughout the Asian range. Same thing, you're looking for an M or W formation. It's the same thing. The best setups happen when you get an apex of 5 or more candles. Same thing, second leg must be in the London box or the New York box. It's very simple. So you'll notice that type 1s, type 2s generally have the same structure. The main difference that makes type 1 and type 2s different is where price gets stuck at. Type 2 patterns get stuck at the top or the bottom of the Asian range. Type 1s literally fly right through the Asian range, high or low, and then make the M to reverse. So you won't see a lot of stop hunting, right? You don't see an aggressive move of stop hunting when you're looking at type 2 patterns. So type 3. Type 3 patterns is basically a move that comes from the top or bottom of the Asian range and hits a brick wall when it gets to the middle of the Asian range. All right? So it comes from the bottom of the top, and it's like a Lamborghini going 150 miles per hour, and then all of a sudden it pumps the brakes and it stops. And you're kind of looking at like price action like, why did it stop? You got a huge engulfing candle, and then all of a sudden it just stops for no reason. But there's a reason. You're very likely to pin a 50 EMA when it hits the middle of the Asian range. This is a very common trait with type 3 patterns. And you'll learn that not everything is a type 3 pattern. Not everything that stops in the middle of the range is a type 3 pattern. Again, we're only trading very specific setups that look a very specific way. We're not interested in trading everything. We're only interested in trading very specific patterns that present themselves in a very specific way. You're looking on a type 3 pattern for a railroad track, a star pattern, or a cow, which is basically a cord of wood, in the middle of the range. The reason that you're looking for this is because this specific pattern will produce an M or W, but the majority of the time will only give you one leg, which is basically the railroad track, star pattern, or the cow. So in type 3 patterns, you will see an M or W form, but for the majority of the time that I've been trading these setups, and these type 3s are my favorite setups, you typically only get one leg, and they usually end in a railroad track, a star pattern, or a cow. I'm going to show you what all this stuff looks like in a second. So let's talk about type 4 patterns. Type 4 pattern is basically an aggressive move that comes out of the Asian range and breaks through the top or the bottom of the Asian range. Now, this aggressive move looks like a type 1 at the beginning. It looks like a type 1. Here's the difference. That after it makes that aggressive move, It makes another aggressive move in the form of a retracement, and it hits a brick wall at the bottom or the top of the Asian range. So the aggressive move happens, and it happens super early in the Asian range that it continues to literally drop into the London session, and you get a pullback. And that pullback just so happens, by miracle of God, to stop at the bottom or the top of the Asian range. And the same thing as a type 3, this pattern the majority of the time will give you only one leg. And it'll typically end in like a railroad track, star pattern, quarter wood. Typically it's just railroad track or star pattern. So you get almost like a one-time opportunity to get into this trade. Now, granted, these trades are not as common as the other patterns. So type 1s, 2s, 3s are very common. You'll see them all the time. Type 4 patterns, you won't see that often. But I think it's important that you know about it, so when you see the behavior happening early on during the Asian session going into London, you'll know what to expect. Now, this specific pattern, the majority of the time, it only happens during the London session, because the characteristics of this pattern is that the move starts super early in Asia and it directly goes into the London session. So those are the 4 patterns that we're going to be looking for in trading. Also, the type 3 pattern also happens during the London session. It's very unlikely for you to get a type 3 pattern during the US session. If you do, that's more likely a continuation in the US session that we'll talk about when we get into the US trading. All right, guys, I hope you enjoyed that video. I hope it brought you some more insights and, most importantly, some value. Guys, if you like the content, please do me a favor and just like the video and subscribe to the channel, guys. We will see you in the next one.